You're watching Magnetic Media News Network. I'm Mia Kudos. This is Behind the Headlines. Because what matters isn't only what happened, it's what happens next. Let's begin. What happened? Global bond yields have surged in recent sessions, marking one of the sharpest rises in months. Central banks across major economies have signaled that interest rates will remain higher for longer than previously anticipated. This shift follows persistent inflation data that continues to exceed targets, particularly in services and labor-intensive sectors. Markets have swiftly repriced expectations, leading to a sell-off in government and corporate bonds. Who does it affect? This move directly impacts governments, corporations, and households reliant on borrowing. For governments, higher yields mean increased debt servicing costs, which could strain fiscal budgets and lead to higher taxes or reduced public spending. Corporations, especially those with high leverage, face higher refinancing costs, potentially squeezing profit margins and delaying expansion plans. Households will feel the pinch too, as mortgage rates climb, reducing disposable income and cooling housing market activity. Investors in fixed income assets, such as pension funds and retirees, are also affected, as the value of their bond holdings declines. Finally, emerging markets face capital outflows as investors seek higher yields in developed economies. What should we watch next? First, keep an eye on upcoming inflation reports from the world's largest economies. These will determine whether central banks maintain their hawkish stance or pivot toward a more accommodative approach. Second, monitor corporate earnings calls for signs of stress in debt-heavy sectors like real estate, utilities, and technology. Companies may revise growth forecasts or announce cost-cutting measures in response to higher borrowing costs. Third, watch for shifts in currency markets, particularly the US dollar, which could strengthen further if yields continue to rise. A stronger dollar would increase pressure on emerging markets and global trade flows. Lastly, pay attention to central bank communications, as any hint of a policy shift could trigger volatility in bond and equity markets. Smart money, reducing exposure. Smart money is currently reducing exposure to long-duration assets, particularly bonds and growth stocks sensitive to rate movements. The logic is clear. Prolonged higher rates increase the risk of capital losses in fixed-income portfolios and dampen the present value of future earnings for growth companies. That is what sits behind today's headlines. Thank you for joining us for Behind the Headlines. Until next time, stay informed, stay ahead. And if you haven't already, subscribe for more intelligent analysis Monday to Friday.